Hi, and welcome to this morning's early global view. It is currently 8 a.m. on Tuesday, April 12th, 2016, and a bit later than usual because we wanted to see quite a bit of the U.S. data that was due out today. And in fact, rather than reserve this for a separate section, let us just say that the big overview is weak, even if there are a couple bright spots. Very important to note right away that Monday's OECD composite leading indicators were weak again, showing further deterioration in important centers like the U.S. and Japan and even Germany, where Europe was supposed to be improving. We got out into Tuesday because there wasn't much else out on Monday. We have to allow that Australian business confidence and UK CPI both came in a bit better than expected. But then we got around to the U.S. again, and we've got NFIB small business optimism quite weak, 92.6 versus a 93.7 estimate. And that's in fact down instead of up from last month's 92.9. U.S. import price index quite weak. And of course we've got the IMF World Economic Outlook, once again, as had been foreshadowed, a downgrade compared to previous. Now, the point is here that the markets tend to be supported by a accommodative Fed at this point. The other banks were accommodative out of December. There were worries about the Fed, but Janet Yellen pretty much reversed that with her speech 2 weeks ago, reinforcing the less hawkish projections in the March FOMC meeting releases and at her press conference in March. So we have to ask, what does all this mean to the markets? Well, it means that the June S&P 500 future, short-term charts, hourly on the left, 30-minute on the right as usual, is up to 2,038 this morning, which is about $3.50 higher. So once again, we've had this ping-pong game going on between the market pushing above 2035, going back to Janet Yellen's speech on Tuesday, March 29th, when it had been down in the testing the 2020 to 2010 more prominent support once again. But right as the speech was released at 11 o'clock in the morning Central Time, we end up with the market back up into and slightly above 2035 and ultimately pushing up to 2060, bouncing down to test 35, 60, 35, 60, 35. It's like one of those old-time cartoon character narratives where he's up, he's down, he's up, he's down. Well, here we are. We were down again yesterday, and that was probably on anticipation of some of the more hawkish members of the Fed speaking this morning, and the fact that the World Economic Outlook that was released this morning was foreshadowed to be weak. So you had anticipatory selling, but now that those are in the market, you've got the market back up a bit. So the question becomes, does it once again hold 2035 to 32, which it's pretty well done, except for some slippage going back to last Thursday when it temporarily traded down to 27, or does it need to go down to the bigger support in the 20 to 10 area? Now, what's interesting about that is looking to open higher today, but let's say it gets beat up. Well, out of today into tomorrow morning, the broader channel on the chart from the last significant sell-off low is up to 2020, along with this key Fibonacci support right here down into the 2023 area. So we have very good reason to suspect the market either A, might still be good from around 2035 to 32, but if it's not, the bears still haven't proven anything on trend unless they also get through this 2020 and ultimately the 2010 area support. Higher resistances remain 2060 to 2064 or so, and then the much bigger resistances we're about to see on the intermediate term charts up at 2075 to 85. And that pretty much does it for the short-term view of the S&P 500.